Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Joe Mazzola, Director of Trading and Education at Charles Schwab, to discuss the June reading for the Investor Movement Index. The IMX is TD Ameritrade's proprietary behavior-based index aggregating Main Street investor positions and activity to measure what investors were actually doing and how they were positioned in the markets. And in June, again, we saw that clients were net sellers, which was interesting considering that the IMX was up for the month. Joe, give us a high-level overview of some of the trends you saw.
Yeah, no, I think that's an important, well, first of all, nice to meet you, Jill. I think it's important with what you just covered there. Clients added to positions, but they were net sellers of equities. And I think that that's critical, meaning that, they added fixed income, they added derivatives, there were other products that they did add to portfolios, but they were net sellers of equities. And some of the selling that we saw was heaviest in NVIDIA, AMD, Tesla, three of the biggest names. And then where they were buying, some of the underperformers that were coming into June. That would have been in like Disney, Target, AT&T. So, you could make the case that they were prudent, maybe selling into strength in some of those names, especially kind of given the year-to-date performance for some of those stocks.
Yeah, it's interesting, Joe. I've been covering the IMX for over 10 years at this point, and I thought the buys were somewhat of a mixed bag and typically not in sectors that we see investors. I mean, AT&T and Verizon to me were a little bit of a head scratcher considering some of the downgrades that we saw in AT&T just in the past few days. Obviously, it's July, not the June reading, but those were just not names I typically see them buying.
I think what you saw there maybe might have been a bit of a technical trade, right? Looking at maybe the RSIs on those were 30, sub 30, maybe trying to buy on the dip, hoping, maybe not hoping, but maybe expecting that by the second half of the year, earnings might turn around in some of these names, giving them a bit of a boost into the second half. I think a lot of that had to do with some of the technical oversold conditions.
I want to get your thoughts going into earnings here for a moment. And big banks have reported, obviously, it's going to pick up steam in the next couple of weeks. The story here is multiples and valuation, and it seems as if you're going to have to report and report well and have guidance to support the run-ups that we've seen in many of these names.
Well, I'll add another thing to that mix as well too. It's dampening inflation expectations, because think about this: PEs are relative, right? And profit to earnings multiples, while they're around 19, 20 on a forward basis, it really depends upon expectations for inflations, because a PE at a 19 is a lot when the inflation expectations are around a 3 to 3.5%. It's a lot different than when they're around a 6 to 6.5%. Meaning that some of those stocks that we call long duration stocks, some of the stocks that you see in the Nasdaq, some of these names that have had the big moves year to date, they're not as overpriced as some might think when you're looking at a lower inflation expectation. Not to say that they can't pull back, and because some of them are in a bit of an overbought territory. But leading into earnings, I think a couple of things are important to kind of keep our minds around, and that's this: expectations for earnings for Q2 are expected to be down 7% on a year-over-year basis from last year. That's about where they were expected for Q1. Q1 beat fairly handily, but they were still, flat to negative by the time everything was said and done. I think expectations for Q2 being down 7%, it's a low hurdle, right? It's a low bar or for the stocks to get over. Should they do that? I don't see any reason that the rally can't continue. Now, I will say this, and I think this is important. I think this kind of goes back to the IMX. I think there's a rotation going on right now. A rotation in that what our clients were telling us that they really wanted to see, they wanted to see more of a distributive property amongst the stocks, because it was that very narrow leadership. Only about 22 to 25% of the stocks in the S&P 500 were beating the S&P 500 really through June. We're starting to see more and more other stocks kind of catch up to some of those, the seven monoliths, or the magnificent seven, I think they're being called now. You're starting to see some catch up. You're seeing it in the Dow. You're starting to see it in the S&P. Now you got about 75% of the stocks in the S&P 500 trading above their 50-day moving averages. So you're starting to see that breadth catch up, and I think clients like to see that.
All right, Joe, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.